Hi fools, welcome to another video from the Motley Fool. I'm Owen Benelak. Now Lloyds is spinning off TSB. We've already seen it in the high street, TSB branches popping up everywhere. Now it's going to take that bank and stick it on the stock market. It has to do this. The European Commission has given it to the end of 2015 to spin off the bank. So it's going to IPO it, it's going to float it on the London stock market. I'm going to buy shares in TSB. I'm going to subscribe for shares in this IPO, and I'm going to tell you why. There are 4 reasons why I think this is actually quite a good deal, unlike most IPOs, which are generally pretty lousy deals. There's 4 reasons. The first reason is that Lloyds looks like it's going to have to sell off this bank pretty cheap, at least initially. It's going to sell 25% of its shares initially, and the range of prices currently is 220p to 290p. Now in the middle of that range, about 255p, that is less than the value that TSB is currently on the books of Lloyds, so they're having to sell it as a bit of a discount. Even a few weeks ago they didn't think this was going to be the case, but things got a little bit rocky in the IPO market, so Lloyds is going to have to sell it a little bit cheaper, it looks like. That's already quite a good reason to invest in an IPO. Secondly, this is a very, very safe bank. This bank has stacks and stacks of cash. Once it's floated, the core tier 1 capital ratio will be about 17%. The average UK bank's core tier 1 capital ratio is about 10 to 12%. So you can see there's a massive divergence there where the bank is much more loaded up with capital. That makes it safer and also gives it lots of firepower to expand and grow, which it is going to need to do to grow profits, but it's got the firepower to do it. Thirdly, and I've already alluded to this, Lloyds is a forced seller. Lloyds can't look and go, the market's a bit soft for IPOs, let's put this off until next year, lads. It has to sell. It has to take this bank to the market. That is completely the opposite of the general situation with IPOs, which is when people who own the company, maybe the founders or private equity or whatnot, go, this is a good chance to sell it to a bunch of suckers at a profit. They time it perfectly. Lloyds isn't doing this because it thinks it's a good time to sell the bank, it's doing it because it has to sell the bank. Again, that implies price is likely to be cheaper than it should be in normal market conditions. That's another bit of wind blowing in our favour. Finally, you get free shares. If you're a private investor and you subscribe up to £2,000 for the IPO, you will get given 1 share for every 20 you hold for a year. So it's up to £2,000. You don't get it if you're a fat cat and you put in 50k. But for up to 2k, you get 1 share for every 20 that you hold, provided you hold them for a year. That is equivalent to 5% uplift after a year. So you basically know that if you hold on to the bank, you'll get 5%. So what have we got there? We've got cheap, we've got very safe, we've got forced sellers, so likely a bargain, and we've got free shares. I mean, that is a deal.